Good afternoon, everybody. Welcome to Trader Merlin for your weekend edition, the trading week wrap up. My Zoom has been messed up the last couple days. Let me get that all fixed. Gotta love. Where's TJ when you need him? Fix my camera over here, get it looking a little bit nicer. All right. So for today's trading week wrap up, it's tough for me to be kind of happy and positive and optimistic with all that's going on up here in LA. Just watching the devastation, it's just incredible. I've got a lot of friends that live up in Northern California, so a few years back when they had their just absolutely devastating fires, pretty gut-wrenching knowing several people that have lost their homes. And I think at times like this it's kind of sickening to hear how certain people use this as political chips and badmouth people and say it's your fault. This isn't the time for any of that type of stuff. This is the time where you got to help out your fellow man, be sympathetic to them regardless of their economic status. And even though these guys are multimillionaires and losing their homes, it still is pretty frightening, and we should all kind of help out where we can. And then at the end of this, we'll figure out what went wrong, how we can fix it, what the issues were, and there'll be a lot of chips to fall after this, I'm sure. So kind of a bittersweet week. Was not the best trading week from a volatility perspective. It was predominantly down, but I kind of have an eerie picture here of kind of a sad guy in a suit looking off to just kind of a city in flames is what it feels like right now. It is pretty bad looking at any of the video footage. Man, when you look at a video footage of a palm tree, which is like, 60 feet tall, and it's just like a giant burning stick, but the flames are going perfectly sideways at a 90-degree angle in 100-mile-an-hour winds. Don't ask how the fire is spreading. Yeah, it's pretty clear and easy how it's spreading. All right, I'm going to cheer things up a little bit, but I do want to start with kind of a question I was torn on bringing up on today's show. So, for example, there was a question that was brought up, and unfortunately I don't have the email here in front of me. I'll get you credit right now. Hold on a second. It was Daniel. So Daniel brought this one up the other day. I'll read his exact email to you, and he says, strictly trade ideas based on current events. Trade insurance ETFs. He goes, I hate to take advantage of the situation. I live in Beverly Hills. Look, I don't think there's anything wrong in any way, shape, or form if you are trading these insurance companies. The reality is most of the insurers out here are giant firms. We'll look at 4 here in a second. There's companies like State Farm and a couple others that are wrapped up that aren't publicly traded, so we wouldn't have an opportunity there anyway. So, does shorting the insurance companies make you a bad person? And I would say no, you're just capitalizing on an event economically. If I'd lost my home, I probably would short insurance companies too, because that they're probably going to default on a lot of this. I doubt that they're going to be able to make all of their payments. So let's go and look at some of the biggest insurance companies that have exposure to California. Allstate is one of the main ones there, the big one right off the bat. Now you look at their price chart. The last 2 days have been pretty ugly. Significant declines in the price of Allstate. Now, at one point, it was down more. I think it was down around 8% at one point today, ultimately finishing down about 5.6%. Now, they are saying that the fires, you hear these estimates and it says, the fires are going to cost $5 billion worth of damage, and then 10, and then 20, and then 50. And now I'm hearing numbers upwards of $130 to $150 billion worth of damage caused by these fires, and I don't even think that includes the long-term economic impact, right? You're going to have a lot of people who are displaced. When you have 300,000 people evacuated from their homes, and let's just say that 100,000 of those have lost their homes and no place to live, it's going to be a little bit tricky going forward with regards to economic growth. I mean, a lot of these people run businesses, and now all of a sudden they're going to trying to find a place to live. Their businesses are going to take an impact. So, I hope that they can get back on their feet. I'm helping out where I can. And as far as shorting insurance companies, I say go for it. You've got to be careful here, though, because remember, Allstate isn't just exposed to the U.S. or to California. They have insurance all over. They also hedge their insurance costs with other investments. And, I don't know how much further it's going to go down. Now, true, Andres. That's a good point. That's a really good point. If you feel like this is kind of a bad thing to do, which is trade these insurance companies to make money, you could donate the money back into the people who are affected. You could certainly do something like that. Absolutely. So obviously Allstate, one of the big names that got hit today. CB, which is Chubb, is another one that has some pretty big exposure. They're down about 3.35%. But let's face it, Chubb's already been in kind of facing some hard times. Before those fires started, they were already down 11.3%. Now they're down about 14.7%. And they're actually hit into a demand zone today. So if you are thinking of shorting these, again, be very careful. I don't think I will do it. I don't think I'm going to be shorting any of these insurance companies. It's just outside of my area of expertise, even though I do think you're going to see more downside movement. I'm not going to jump on that one. Another one, the Progressive, right? PGR, name your price gun. Yeah, that price gun's going to change its premiums here real quick. Down 3.28%. This one looks like it's kind of in uncharted territory with regards to new lows. So I see an unfilled gap on Progressive that goes back a couple of months. I'll put a line right there so you guys can see that. And there's the origin of this gap at $222, and right now we're at $235. Wouldn't surprise me to see it kind of drawn towards that gap and fill that gap. You know, the $20 slide, about a $13 slide from here would represent about another 5% down for Progressive, and certainly could do it. You had Travelers. TRV is another one that has pretty big exposure out here in California. They were down 4.26%. But all these insurance companies we've just looked at have already been looking pretty weak, right? Pretty weak. So, yes, you could go and short them. I think what you probably wanted to do is before these things, or as you saw them break out, go for it and start shorting them. Now you'll kind of be in that chasing category of chasing these insurance companies down. Now, this brings in a much bigger impact. So, obviously, California is one of the most expensive states to live in, and insurance costs are not going to get any better. A lot of insurance companies have been pulling out and denying coverage for people in fire-prone areas like Pacific Palisades and other areas. One of the reasons I sold my property in Northern California was no one's offering insurance up there. It was in the Shasta-Redding area, and no one is offering insurance. So why bother building a house if I'm going to get a loan because I got to have insurance on it? You're not required by law, by the way, to have insurance on your home, only if you have a mortgage. So anybody's got a mortgage, which probably should do. And mortgages are a great way to take advantage of a declining dollar and also low interest rates. If you have a mortgage, you have to have insurance. And if you can't get insurance, you're going to have to go out to some specialty third-party place, and those ones are really expensive. The insurance costs in Shasta County skyrocketed, and I just said, forget it. Dumped the land as it was, got a pretty decent price for it, and walked away from it. So, right, you get the reinsurance who are insuring the insurance companies. I mean, they talk about a domino waiting to fall. One of them will drop, and then the other one, then the other one, then the other one. For me, what it means is, I try to plan ahead like kind of a chess move would be. I don't know the exact number of homes that have been lost. We'll total those up here in the next couple of weeks after these fires finally get put out. Fingers crossed we get them taken care of. Ultimately, what's going to happen is real estate is going to become very desirable, far more desirable than it was before, which means areas of Los Angeles that weren't affected by these fires, who still have standing homes, are probably going to see the property value increase significantly as others are looking to find a place to move to and live in the Los Angeles area. What does that translate to? That translates to higher prices. That translates to higher rents. Now, not only that, but the insurance premiums will be spread to people like myself who live in California. And I'm pretty sure when I get my renewal, my insurance premiums will be moving up and up and up and up. So altogether, this is going to make California a much more costly place. And I wonder, looking forward 6 months, maybe a year or so, do we start to see a net exodus where people are starting to leave Southern California and go other places? Because now they can collect some insurance money if the insurance companies don't default and move away with a big chunk of change. Because let's be honest, going back to those areas and trying to rebuild right now is going to be pretty tough. They did it in Sonoma County, Santa Rosa in particular, but it's taken a long, long time. And also trying to find contractors to build homes is a precious commodity when everybody's trying to build their homes. So they said $50 billion damage. It's going to be more than that, Oliver. It's going to be more than that. So, yeah, we're going to have real estate prices surging because of people looking for properties. I sold a house in Northern California that I got about $100,000 more just because of the fire. And I know it sounds selfish and greedy. I wasn't really ready to sell my place at the time, but because the prices had surged so much, basically, and before you start getting on my case and saying, hey, Merlin, you took advantage of people, I did not. It was a market condition where everything went up in value. If you look at it from one perspective, you could say, well, I'm selfish because I sold my property for a higher price. At the other side of it, I am also providing what those people were looking for. They were looking for homes, and I provided a home for that. And I know some people will attack me for that. You're taking advantage of a situation. I think you're going to see something similar in Southern California. Now, to be fair, I think a lot of those homes may not have been primary residences. A lot of those are multimillionaire, really, really wealthy people who have other places they can go and live for a while until things get rebuilt. So it might be slightly different. But I think the cost of real estate increasing is going to get passed on to the end consumer, which means rents are going to increase. Insurance is going to increase, which means rents will increase more. Ooh, it could be a pretty ugly place out here in Southern California. Wow, which I think could have a pretty big impact on our markets and the economy here in SoCal. So, ugly situation. I hope it gets resolved quickly, but I think the economic aftermath is going to go on for quite some time. Margaret says, how close am I? I'm not that close from the Palisades. I flew over Palisades on Tuesday, Wednesday. Crazy. Yeah, I bet, John. I've seen some video footage from airplanes flying in LAX, and just it looks like you're looking into hell. Right? What you would think of hell looking like, just this giant cauldron of fire. Yeah, that's what it looks like. Pretty crazy. So, how close am I? I'm not that close, although I did get an alert this morning saying that we were on fire watch down here where I live, but I'm not that concerned. I have, I'm not that concerned where I'm at. However, when you have 100-mile-an-hour winds, things can change very quickly. So I have started, I'll probably work a little bit more after I finish the show today, putting a pile of critical stuff, things that, in my opinion, I have to take with me, and watching some of the just tragic, gut-wrenching videos of people. Most of the stuff you hear them really talking about is the personal items, the personal impacts, the pictures of their kids, the pictures of, family members or grandparents. So, Jim, if you're, I'm right around there as well. I'm a little bit more than 30 minutes, but there are fires jumping up all over the place. And again, with high winds, it can happen real quick. So, everybody, if you're ever in that situation, you go for the more critical stuff. Like, am I taking this computer? Absolutely not. Who cares? I can buy a new computer. It's the things I can't replace that I'm looking for to take with me. So I got a little go pile in my garage. Tofi says, aren't the winds dying down? So the winds yesterday afternoon were 0. I went for a walk with my dog. Not even a mosquito fart worth of wind. I went for a walk last night around 7 o'clock, and I was getting gusts of like 40, 50 miles an hour. It knocked my dog over. Of course, he's an older dog, but it was real big gust last night, and I was like, oh no, here we go again. Now it's a little bit breezy, but nothing bad. Hopefully, we will get these fires under control and the winds stop and really just work with us for a little bit. But I'm sorry, Jim. I know it's the only thing you can do is really just open up your doors to your friends and family and be like, hey, I got a place for you to stay if you need it. I can help you out there and help you get back on your feet. It's terrible when stuff like this happen. Yeah, good. Hope it stays calm, Jim, especially if you're that close to it. Hope it stays calm. All right. Oh, you're in Cerritos, Oliver? Okay, you're near it. No better motivator to get my trading on point. Like there was a way. Yeah, everybody, Jim, Oliver, just get a stack of the really important stuff. Just put it in a spot where you can load it in your car in a couple of minutes and be ready to go. If it does happen to get your way, which we all hope it does not. We hope it all stops here. Yeah, the arsonists, and I'm sure we have several of you here who are not capital punishment people. And I get that. I understand. I am a capital punishment people. Again, I've mentioned it yesterday. I believe that this is an unbelievable privilege to walk this earth in this one marble surrounded by trillions of different marbles, and we've got the only real life that we've found so far. Yeah, this is an honor. Let's not do this type of bad stuff. So these people, if I've got video footage of you throwing a bottle of alcohol into a field in 100-mile winds, I'm sorry, I'll buy the bullets. Take these people out. Done. You don't deserve it. You killed people. You cost people everything they had. Damn shame on them. This is market action of December, January topping. Remind you all of December, January topping in 2001. Yes. All right, let's shift from the sadness here, which are these fires, and talk about our market. So there's definitely some comparisons that can be made. That can be made for sure. So let's go back into 2000, as you point out there, Mike. I'll go to SPY, for example, and we'll go into the 2000 peaks, right? And things were looking great in 2000. The big difference in 2008 was, you had 2001. I was thinking more 2008. But if you go into 2001, we can do that same analysis. Unfortunately, back here, we were at all-time highs, so we had nothing to go off of. And then things just kind of slowed down. So let's look at price action and kind of walk through, the way that I look at things, which may not be the way you look at it. It's okay. For all intents and purposes, this market right here, and this is from 1998 to 2000, everything looked great, right? It was still trending up. Yeah, we had pullbacks, but no big deal. And at this point right here, which is this double dip bottom we had in September of 2000, not the end of the world. We didn't make a new low. And then all of a sudden, we made new lows. This is that moment where you went, uh-oh, this is not good for the SPY. It basically means that giant uptrend, and that happened right around October of 2000 is where we finally started to make some new lows. And then it became a clear downtrend, lower highs, lower lows, and just kept on going. Let's go back to the 2008 situation, right? So here we have a market that was trending strong, looking absolutely fantastic, right? Looks great. And once we had this little dip below the pivot low on June 27th of 2007, that was your first warning shot. And this did not mean, right, if I'm looking at this chart here, this does not mean that the trend is, that the market's going to crash. It simply means that the markets are slowing down and all of a sudden buyers are no longer pushing up as much as they were before. Now, what you would expect to happen here is, okay, it made a new low. It'll probably rally up. And now the question is, does it break this high? Does it break that previous high at like 156? It tried and then made a new low. At this point, now you're starting to get concerned, and your realization is that you have this low point right around, come on, my cursor's not going to, right around 136 on the SPY. If that breaks, then, that's another signal that you should be just running for the hills. And we rallied up. Things look great. Okay, new high. Okay, then we move that back up. I'm just scrolling forward here. So at this point, I'm moving my trigger point higher. And there's your exit. So either way, if you kept it or did the same. And I could actually tell you why my number was 1260. It was basically exactly all of it. You're breaking the structure of the chart. You're breaking significant turning points, whether those are demand zones or supply zones. At this point here, things broke and all of a sudden it got weaker. Now take a note of this picture right here. This is from 2006 all the way through the very beginning of 2008 when I was kicked off of CNBC, convenient enough. I was in December, I was on CNBC, and in January, I was on CNBC. So, we obviously had significant down moves from there for a prolonged period of time, and no one really knows when exactly that's coming. But we will scroll forward here through what we have today, and let's just play that hard right edge off today's price action. All right? We have the same basic picture. Let me get rid of some of these lines here. Apologize, I was doing all kinds of drawing and some trades today. Nothing looks broken here. As of this point right now, this picture looks absolutely fine. I would say nothing here is out of the ordinary. It looks fine. And here we are live, real time as of today. Okay, so I don't think this is any cause for concern. But if, as Oliver says, breaking structure, if the structure of this changes, if we start to see new lows put in next week, and then it tries to rally up and doesn't make a high that breaks this high from this week, January 6th and 7th, then you got to start thinking a little more pessimistic. And I understand the whole market, economists, CNBC, Fox, Bloomberg, everyone's talking about how great this year is going to be because of Trump and it's going to be an economic boom, yada, yada, yada. Hey, that may be. But again, I'm not trading that. I'm trading price. Trump's talk track, China's talk track, anybody's talk track does not impact my trade. It's price, right? This is where I'm making money, is off of the price action. I'm buying or selling that number of this symbol, and that's really the essence of trading. Now, certainly I could push my opinion on this market, but I don't think you need to do that. I think you just got to look at it and say, okay, let me wait and see what happens. So we may get a point here where we break lows, which I kind of feel is coming. It feels like we're going to start to break the lows here, and we'll probably go back and retest this low. And let me put on the SPX just so we can have the real market, not the ETF. So here's SPX. My idea, and again, this does not mean it's going to happen, but I feel like there's a good probability we'll end up coming back down to this level here, which is between 57, call it 5,700 and 5,728. So you got a 28-point range there that I think will probably come back and test. If that gets broken, then, I do think you're going to see more downside movement. That would signal to me that we have made some new pivot lows, and it'll probably bounce off that 5,700 level, maybe get back up to 58, 59. And if it doesn't do that, if it doesn't, break these highs at 6,000, then we're probably going to be going lower, and that's okay. As GS says here, seems like the ice is cracking. Yeah, and again, this is just an opinion. The bottom line is there's no way you could argue this and say this is not true. My statement is the market is slowing down, and you cannot argue. You cannot tell me I'm wrong. You feel free. You can get in a debate here. I can have you call in on a phone number and we can argue online about this. But the fact that the market for the better part of 2 months now, all of November, all of December, and beginning of January, has been in a sideways range that is now starting to look weaker. It's not making higher highs. It's actually making lower highs right here. You guys can see that. Lower, 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 lower. And all of a sudden, we're making lower lows. I'm not saying it's collapsing. Absolutely not. But it's certainly getting weaker. And when things get weak, it's like this loaded coil. It could happen very quickly. We've got some big economic pieces with these fires, etc. We'll talk about the economic data that was released today, which may also impact the market. So just kind of, I would say, get yourself prepared and get your plan in place. And if we do break 5,700 on the S&P, what are you going to do? Right? What are you going to do? Are you going to sit there and watch it and go, oh, wow, I saw this coming, but I didn't want to do anything about it? In a very bad analogy, but it's very, very relevant today, I've seen people that are standing in their living rooms recording these fires race towards the home. And in my mind, that's kind of a silly thing to do. You should be preparing for, what do I do if those fires reach my home? What's my way out, right? What can I salvage from this? So if you're long, 32% gain for me just over here, that's great, John. You don't want to give that back, do you? You certainly don't. So, have your plan in place. And I'm not trying to influence your plan in any way. Everybody here should have an idea of, here's my financial situation. Here's my portfolio. These are my investments. What do I do with each one of these to hedge, protect, or in my case, capitalize on downside movement, right? If this does in fact start to break even lower. So have your plan in place. Make that your plan for the weekend is, how am I going to plan on this? What's my plan for the next, if this happens? If this happens, here's what I'm going to do. Map out your plan. That way you're not going to get caught off guard and freaked out. You just know what you should do when it gets there. And see, here's the worst thing. Let's say you've got big gains. You got real big gains in the market, and you're holding long-term positions. In my mind, you've got three choices if the markets start to fall apart. Number one, you can just hold your positions and do nothing, which in my opinion would be stupid. Number two, you could buy directional puts, right? So buy some puts and hedge your portfolio so it stays neutral. That's one option. And that would be used if you don't want to sell your positions and take the capital gains hits, the tax hits. You could also just close your positions and go to cash. As I saw here, John G says, nope, going to cash on Monday. There you go. I mean, what's the worst that happens? The worst thing that can happen to John G here is the market rallies like it's never rallied before starting Monday, and he just went to cash. That's the worst that could happen to him. The best thing that could happen is all of a sudden it goes through a flash crash and we see these markets drop 10% in a day, and he's sitting there on Tuesday going, man, I nailed it, right? Now, I don't think that's going to happen, but what if, right? What if? We've had the longest bull market rally in history, and I've shown this chart to you guys before. I showed this to some students when I was teaching out at Charlotte, and they were brand new to trading. They'd never seen this chart. And I went, okay, guys, and I know you guys know this, but I'm going to show it to you anyway, just because I think that this is something, you should show this to anybody who's a skeptic on these markets. And that is that this first drop here, this sell-off from March of 2000 to the lows of 2022, which lasted 133 weeks. Let me make this a monthly time frame. I'll just save some space. Oh, it goes back to 1930s, not where I wanted. Here we go. You look at this big one here. This was a 50% decline in the equity markets in 31 months. So, 2.5 years, almost 3 years. That was 51% decline. Oh, that won't happen again. And that was the dot-com bubble. Here's our financial crisis. And again, both of these are in history books. These are in history books, man. In college textbooks, they talk about market crashes, and you got the Great Depression, you got the dot-com bubble, and you have the financial crisis. And then you look at what the markets have done since the government started manipulating the money supply. There is clearly something wrong here. And oh, wait, Tom Barr doesn't visit us anymore because I must have offended him, but I'll change this to a logarithmic scale because that helps, right? I still think it tells you the same picture, that there is clearly this influence and sway by our governments and spending and printing money that have caused these markets to have the biggest market rally in history off of these 2009 lows, right? From that low point to where we are today, our market has moved roughly 785%. It will give some of that back, right? It will give some of this back. I just don't know. Now, you saw here, I did 50% decline on this first one, dot-com bubble. Here is 57% on the financial crisis. Let's put Fibonacci lines on here and get an idea of where those numbers may be. Where are the pullbacks? That is, oh, that's logarithmic. Okay, this is logarithmic, so it's skewing the scale. But if we had a 50% decline in the market, it would bring us back to 3349 on the S&P. And we're currently at 5,800. All right, that would be a 50% decline in the market. So I think we'll get there. I don't think so, but nothing's off the table. We've had 50% declines twice, and it just feels like we're long overdue. Would a 38% decline be more likely? Sure. I think that obviously it's going to hit that before it hits 50. Well, that would be a 34% slide in our current markets. And again, it's all about triggers. It's all about when that market gives you those signals that says, hey, here is the moments we need to be selling, and we may be there. We may be getting close. I don't think we're there yet, but I think we're getting close. Anyway, well, you add 10 trillion in cash to the market over 15 years. It has to go up. They added 17 trillion, Steve. $17 trillion were added in an M1 money supply between 2020 and 2021. To bring that up and show it to you, just type in M1 money supply. And the first chart that's there is the Federal Reserve. Oh, I'm sorry, I hit the wrong button. I got excited, Steve, on your comment there. It is even worse, but there it is. I just want to make sure we get the numbers right. So here in 2020, we had $3.9 trillion worth of money, and then we peaked out here at $20.7 trillion in April of 2022. So 2 years. Unbelievable. Really just kind of crazy to think that it just blows my mind. So yeah, what could possibly go wrong? So, we'll keep our eye on this one going forward. I'm still bullish. I'm still bullish these markets, but my enthusiasm for bullishness has dissipated quickly because of what's gone on over the past couple of months. It just doesn't look great. And, I think we're in a very different situation now than we were before. I do personally feel like the market rallies in 2008, 2009. Yes, there was a lot of tech, but I feel like the tech was somewhat spread out. Now you've got 7 companies that are really driving this entire show. The entire show are being driven by these 7 companies. And, we'll look at those real quick here so we can take a peek. They did not have great days today. You had one positive, which was Meta. And I'll just zoom out a little bit so we can see what's gone on with Meta over the past couple of years. Meta back in 2022 was $88. Now it's $6.15. Tesla, back in 2022, same point, was $102, and now it's $3.95. Google, Alphabet, back in 2022, this thing was a $83 stock. We're at $183 today. Microsoft, currently sitting at $412. It was back at $213, up 100% since 2022. Amazon, my favorite on this list just because I love Amazon. Amazon was sitting at a wonderful $81. Now it's $225. So these companies have done remarkably well. Apple, back in 2022, was $124. It's actually performing the worst. It's only up like 90-something%. And then there's, of course, NVIDIA, which back in 2022 was trading at $10 and now is $135. Ay. So, yeah, these guys are the ones that really have been the catalyst for this market going up. And if there is a slowdown, if there is other issues that could potentially slow it down, they may see some big downside movement. And that, goes back to some technology. So, we have a TikTok ban coming up. And today, Steve says, I own all those companies from 2022. Yeah. Awesome, Steve. Good for you. That's a good portfolio to have, I'll tell you that. So the TikTok ban is going to be an interesting one. Supreme Court today started hearing testimony from the different participants in this case. Remember, the Biden administration signed in a federal ban on TikTok that will go into effect on January 19th if they do not sell their assets to an American company, which I think is kind of interesting. And if it does go through, I feel like it could actually create bigger problems, because if America can now say, your company's products aren't allowed here without us owning it because we're worried about privacy issues and spying, which is a legitimate argument, let's be fair, then what extent do we see China put bans on our exports to them based off of that same privacy concern? Are they no longer allowed to use Google? Can they no longer use Apple products? Can they no longer use Amazon? Can they no longer use Meta and Facebook, right? China could fight back with this tit-for-tat type of approach. It says, oh, well, if you want to use Facebook, you got to sell all the Facebook assets to China. And I don't know how serious it's going to get. My gut kind of tells me it's going to get resolved before that. And Mr. Wonderful Kevin O'Leary says he'd buy it for $20 billion. Kevin O'Leary said he's trying to buy TikTok. Yep, he did, Oliver. He said $20 billion he'd buy it. I don't know. I don't really trust Kevin O'Leary, nor do I like that guy, but the U.S. version of TikTok. Well, look, I think, or Tesla. Yeah. Oh, yeah. Tesla's got all the AI. You're recording, your cameras are recording every person's car. So now you know all this information about China or wherever country those cars are in. Yeah. It opens up a bigger discussion into privacy and who controls that information, who controls that data. But it could have a big impact on the 19th. So there are some big pieces of news happening on not next week, but the week after. And I'm going to be very careful about that, about my trading that week. So, for example, MicroStrategy, which I do own shares long on, and I'm selling calls, I'm selling puts on it as we speak. I sold some 320. I sold 320 puts today, and then 370 calls against my open position. I'm going to try to close that position by the 19th. For those of you who may not know, MicroStrategy is going to put it to a vote to their shareholders. I have a vote, by the way. I get to vote. On whether to increase the shares from 300 million to 10 billion so they can buy more Bitcoin or not. And that could just create a crazy amount of volatility in MicroStrategy that I do not want to be holding MicroStrategy. And maybe I could hedge it, I guess, by straddling it, but I'm not going to do it. Was banned in India. Not sure what happened there. I don't either. January 20th is going to be a crazy week. Absolutely. We get really close to a rate announcement. You've got the TikTok ban, which I think will set waves through tech. And remember, if we get these sort of restrictions put in by other countries where China, right? China's like, oh, you're going to ban TikTok. We're going to ban Google. And then we'll ban something else and they'll ban. And what's the impact on Google, right? Does it have these tech companies nervous enough to where they're going to start to crash? And you look at what went on with some of these Magnificent Seven stocks; they're still performing very well at all highs. Now, the 20th is the inauguration, which of course will create a lot of volatility in the markets. And ideally, it's going to be a positive thing, but you just never know. You just never know. So many things can happen. But the TikTok ban is going to be a very interesting one in my book. As I mentioned, the Supreme Court is right now out there listening to arguments from both sides on which way it's going to go. From what I've been hearing, it sounds like the Supreme Court is probably going to uphold the law, and that would be bad news in my mind for tech. So keep your eyes open for the markets next couple weeks. I think that this TikTok story will have a big impact on tech. Proprietary rights, content, could be very interesting. All right, next. We talked a lot of negative stuff, so let's talk about some positive things here. Before I get to this one, real quick, in yesterday's show, I talked about my trading results, and I was kind of going back through and looked at the futures one in particular. I was kind of breaking down, and by the way, one of my worst losing trades, other than Boyle, the Boyle trade was the worst. One of the worst things that happened to me wasn't the trade that I made. You guys might remember I was using NinjaTrader, and I had a bracket order with an entry, stop loss, and price target. And I had put that order in, and I left. I actually had it on the computer downstairs, and I ended up logging out of that computer, and I came up here to do a show, and I didn't open up NinjaTrader. And it hit my target, but then it still opened up a short position when it hit my stop loss because it was an unprotected order, and then I ended up taking a huge loss on that one. It was like my biggest futures loss trade. So my numbers would have been a lot better if their technology had been working the way it was supposed to work. Unfortunately, that happened and ended up being one of my worst losses. Okay, let's go back to jobs data. News today was really good. Honestly, I think this is very positive news for our markets. We'll look at the breakdown of numbers, but you had the non-farm employment change. And first off, the non-farm employment change was supposed to go from 212,000 down to 164. And we talked about that yesterday. I was like, that's a significant drawdown, right? Significant drawdown. Well, it came out at 256, which is very good. Here is the zoom in of what happened. You can see the little gold line there represents expectations. The blue line is reality. I mean, that's impressive. Great beat. So that's a very positive sign. More jobs being created. And then you look at the unemployment claim or unemployment rate, which came out right after that. And we went from 4.1 to 4.2, which is also very good. Now, granted, it's off the lows of 3.5%, but oops. Sorry, I keep clicking the wrong slide. I'm moving too fast here, Steve. I just wanted to show you Naomi. All right, so I'll do this backwards here. I will show you. She's hiring. Naomi's hiring. I'm kidding. Just kidding. She's a very, very pretty woman. So here is the unemployment rate. Sorry about that, guys. I was going nuts there. This was supposed to be 4.2, and you can see the estimate there, which this isn't really like a shocking kind of surprise number, but it's good. It's good to see it drop back down just a little bit, although I am in the camp that 4% unemployment is not that bad at all. Let me go back to the non-farm employment change. This is the one that I think was really a surprise to most people. They were really anticipating it dropping down here to, as I mentioned, like 164. And we came out at 256, a complete about face from expectations, which makes me wonder how transparent these companies are with their information. But honestly, this is really good news. This is good news for the markets because it means there's more stability, there's more job, there's more growth, etc. Now, what does it mean for interest rates? It's not good for interest rates. It really, because you would really, it fights the argument of inflation again. More jobs, more spending, more inflation on the horizon. So this has a lot of people freaked out that the Fed is not going to cut rates anymore. And if inflation does continue to rise, well, I personally, if I mentioned before, I think that the Fed has already backed themselves in a corner by making that 50 basis point cut to start and juice the system. So in a few months, I think we'll start to see inflation back on the rise. We do have next week CPI and PPI numbers coming out on Tuesday and on Wednesday, and expectations are that those are going to come down. So I think our next month or two readings are going to be normal or down, and then I think you're going to start to see it slowly start to tick back up here on inflation. And then it begs the question, do they have to raise rates going forward to slow things down? I'm with Big Eb. I don't think any cutting. Steve says rates should stay here anyway. They should stay here. I personally think they should go up a little, but I'd rather see them just leave it here and not create any more waves. What's going to help us understand the bigger picture is that long-term end of that yield curve, and we have definitely seen that one. Let me see if I can bring up this really cool animated yield curve. There was a really cool animated yield curve chart that I used years ago from stockcharts.com. And here it is. So let me show you this one. So this is where we're at today. So we actually are back to a normal yield curve. You guys can see that. It's pretty good. We are normal. However, that short end of the yield curve, has some room to go down. And I'll animate this, which is really kind of cool. You can see it back from 1989, and I'll just kind of put my cursor over here so we can see what happened. This is in 2015. They pulled that short of the yield curve all the way down to zero and kept it there until just recently. And now all of a sudden, we went inverted. Why is my cursor's all messed up? There we go. We went inverted right around 2022, in August of 2022. And you can see there, we were inverted for a long period of time, and we are uninverted now. We are definitely back. So you see how extreme it got. But now watch what happens. That long end, the right-hand side there, that long end of the yield curve starts to move up significantly. And then they start pulling that left side of the yield curve down. So come on. It all happened last year in 2024, and here it goes. That short end's going to get yanked down real quick here. Boom, boom, boom. Yank, yank, yank. And now we are back to normal on that yield curve. So, these are still relatively elevated. Oop, now we're back to rate. The yield curve looks like it did back in 1999. Kind of interesting. I'll pause it. So, I think the long end of that yield curve is going to go up. We had this debate a while back, and Big Eb thought it was going to go down. Big Eb was correct, although it went right back up. If you look at the 30-year, we're starting to move a little too quick on these rates, I'll tell you. Here's the numbers for today. The 10-year shot up 1.58%. So now we're at 4.763 on the 10-year. A big up day. And again, I do think we're going to get back up to this 5% line here pretty soon. You look at the 30-year, which I think I have down here. Let me get to my 30-year. 30-year was also up pretty good today. I mean, at one point today, we did hit 5% on the 30-year bond, which is great if you want to buy long-term instruments. We hit 5.005 on the 30-year today. So the long end of that yield curve is starting to accelerate to the upside. And again, that's this culmination or just compounding of more debt, sell more bonds so we can pay the interest on this debt. And if we get more demand for it, great. We can sell the bond. We can sell the bonds to someone, but if we don't get demand, we have to offer much higher yields, and that could be a pretty bad thing for us going forward. So not great on the interest front. And I guess, as I should do every Friday, we'll just go look at that Fed funds rate chart because I just love the chart so much. I know, Margaret. Every week I'm going to bring it up I'm going to call it the Margaret chart. Right now, that FOMC meeting is going to be on January 29th. 93% probability they keep things the same. But the one I've been kind of keep bouncing back to is the one for December of this year. Now, when we looked at it the other day, there was a 30-something% chance of a 25 basis point cut. Right now it's 43. But notice something else that's new here that wasn't there the other day is the higher side. There was no chance of a rate increase at all yesterday. Now all of a sudden there is a chance of a rate increase by the end of the year. So we've seen that thing shift over the last 24 hours, last week as well. So is the yield curve managed? Define managed. So the short end of the yield curve is managed, right? The Fed is what's controlling the short end of that yield curve. However, the long end is based off supply and demand, and we have a lot of factors driving that one. And depending on our relationship with other countries, that could impact demand significantly. China used to be one of our major buyers of our long-term bonds, and so did Japan. Now the largest buyer is the Fed. So you've got like the drug dealer getting high off their own supply. Usually that does not work out very well. The 2-year bond rate is above the Fed funds rate. Yes. Yeah, the Fed funds rate's the lowest one. It's always going to be the lowest one. Remember, these guys got to sell these bonds and make a profit off them. Otherwise, they could just get the Fed funds rate. Let's see. Yeah, but the 10-year is up over 13% in the last month. I agree, 5%. Oh, great. Now Big Eb agrees with me. Dang it, Big Eb. You're supposed to disagree with me, and we're supposed to make a wager on things. No, it's not good. It's not good. We talked about this with Bill Addis a while back, talking about the potential of, bond rates getting up to the 1980s level. And neither he nor I believe we're going to get to 18% on your 10-year like we did back then. And I'll show you that chart because it's a pretty crazy chart. Here's your 10-year, but this is on a daily. Let's go out to a monthly so you can kind of see the longer term. We've certainly seen a humongous rally. And, keep in mind also, folks, that how much this has moved from those lows in 2020. We were at 0, and now we're back up, nearing 5%. This also impacts an economy significantly. I think that I'll be honest, I still think that the economy is enjoying some of the liquidity and benefits of having money at 0. But those bonds, those financial service products they may have purchased back then, they are coming due, and they're going to have to refinance at higher rates. Not great. Tariffs will increase that yield as well, will it not? Yes. All right. Tariffs are going to just add more pressure to that because part of it is you're going to create tension with other countries, and they may not be buying U.S. bonds. So yes, certainly it could increase our yields as well. Going to be exciting. Exciting 2025. And, it's especially exciting when you get a brand new president because while we've already had Trump as a president and understand some of the things he's going to do, and I know in my mind, like I'm going to be focusing on his social media stuff because he's always just manipulating through social media. He did it in his entire 4-year his presidency. But, what other things is he going to do? As I mentioned, he does a lot of shock and awe. He'll say things that I think he just doesn't really think about, which is great for markets. It creates volatility, so I'm okay with that. Well, no, I'm all in on board with John G. idea. What selling? Oh, now? Well, don't jump to conclusions yet, Steve. Don't. I apologize. I'm not here to spread doom and gloom. That's not what's going to happen. It's not going to be a sudden thing. Let's wait for the signs. Let's wait for things to start to show themselves before you go all cash or freak out here. Again, I'm not trying to spread doom and gloom. It's just you got to look at the numbers and facts as they present it. The most interesting one is not the discussion that we just had about jobs and all this stuff. It's the price chart itself, right? You look at that SPX, look at the S&P 500 or NASDAQ, whatever market it is you trade, and on this monthly, it is about as beautiful as you can make it. It's about as pretty a trend as you're ever going to see. But all good things do come to an end. And to put that financial crisis in perspective off the left-hand side, that was 57% slide in 17 months. Now, I don't know how far it's going to go, but I do think that there's a great chance at some point here in the near future we could see a market sell-off. What caused this? What helped our market surge that much? Cheap, easy money. Cheap, easy, and free money. Right? Some people, some of you maybe even have received those, non-payable bonds where you got a loan, but you don't have to pay it back, which is called a gift in my book. There were a lot of people that got those from the government. Some people got the stimmy checks, and just went and spent all that stuff. And that's probably not going to be around this time around. We'll see. Who knows? I'm not doing back-to-back hour shows. Merlin, what is your line in the sand if you were to liquidate? Well, it would be a combination of things. So if you look here on the S&P, I've kind of mapped it out here actually. What I think is going to happen, and I'll take this line off, I think what we're going to see is a slow rollover of price. Now, it'll probably at some point get down to this 5,700 level. My guess is that we're going to try to rally up. And if it makes it to, let's say 58, 80, 5,900, great. Then I think we're going to come back and we're going to challenge those lows and maybe break and make new lows. So it's right around that 5,700 level, although I think the first time is not going to be the one that really breaks it. I think you might break it, but it's going to come and retest real quick. It will probably actually do this. It'll probably go below it and look like a bear trap for a couple of weeks, right? It gets people short and then screams up and has you all second guessing and go, crap, I should have bought. Never mind, I'm going to buy in again. And then it falls. So what I think is going to happen is you're going to have a head fake breakdown, right? A bear trap. And then I think it's going to rally back up, cause people to freak out and buy into it again, and then it'll really start its decline. So it all revolves for me around that 5,700 line on the SPX, and we'll see. We'll see what happens when we get there. Joe says, hi, Merlin, will this possible slide greatly impact the crypto markets? Yes, but I think what's going to impact the crypto markets more is political. We talked about the strategic Bitcoin reserve for the government. That is already written in a document where Cynthia Loomis has outlined buying 1 million Bitcoin. They'll print money to buy that Bitcoin, use that Bitcoin profits possibly to pay for, or use leverage it and use it to pay for other things. But I think that you'll see some sort of immunity for Bitcoin in particular if the market does sell off. And that, of course, all relies on, does the government establish a strategic Bitcoin reserve? And if they do, then buckle up, put your seatbelt on. Bitcoin's going a lot higher. If they don't, then yeah, I think you can see some downside movement, particularly if it's a prolonged sell-off and it's a painful one because people will need to cash out to pay for day-to-day operations, living expenses, and things like that. So, not really. Jeff says head and shoulders. Not real. I mean, I guess you could up here, but that would give me a different trigger point. Right, head and shoulders would be up here. You got the left shoulder, the head, the right shoulder. So yes, you could argue that would be one. And if that was the case, your target would be from the peak of the head to the neckline, which would be roughly there. And that would give you a target on this breakdown, which is only, call it 5,600. So yes, the top part would be a head and shoulders, but not this lower part that I've mapped out. Let's see. It seems the line in the sand is Trump's winning day support level. Well, I don't know if it's necessarily the winning day support. I mean, he's got a lot of supporters, and let's hope that the transition goes smoothly and nothing crazy happens, right? Oh man, heaven forbid, we get some idiot tries to do another attempt on him on his inauguration day. I'm pretty sure security's gonna be a little bit tighter than it was at that rally, but barring any outlying events, it should go smooth and the market should be okay with it. What really, in my opinion, is going to matter is what does Trump do now that he's in office, right? Once he takes that office, those first 100 days usually is a bunch of really crazy stuff getting thrown around. What happens? What's he going to do? That may create some big waves. Of course, he's going to pardon, most of the January 6 people. That's pretty sure that'll happen. And pardon some other people and just get them out of there. And then he'll probably go for crypto. And then what does he do? Does he implement tariffs right away? Does he take some time and think about that with his cabinet, which I think he should do? I don't know. Then got to the fourth day. Fourth day? Wait a couple days after. Let's wait and see. All right. Let's go look at your economic calendar for Monday. I didn't even bring a drink with me today. I'm surprised. I was in the mood, but you know why? I'm doing dry January. Throw it out there. It's tough. I want my glass of whiskey here. I got a really nice bottle as well, so I have to wait until February to go have a little sip with you guys on a Friday. All right, economic announcements for Monday. Monday is actually super quiet. There's really nothing going on for our markets. You can see here we didn't even have a name on that list, so nothing going on. Lee says, take Greenland, the Panama Canal, Canada. Oh, man. Yeah, I guess. We'll see. We will see. There's definitely talks of him wanting to do that. He said, take it by force. Oy, oy, oy. Let's hope that doesn't happen. Merlin, would you say the second half of the year would go down? Yes, Chio. I believe the second half, so we're going to start to see my, I think that's when the pain's going to come in. I think the excitement, the party, will have simmered down by then, and then it's going to be the hangover. And I think the second half of the year is going to be the part that brings the market down. And again, I said that 2 years ago, and it actually did happen 2 years ago, but it was the last quarter where it started to sell off. Got you covering the drink. Awesome. Are you still in Hawaii, Big M? Are you ever going to come home? Jeez Louise. Nobody said anything about force. I'm pretty sure, John, I did hear a take it by force comment. I'm pretty sure I actually heard that, which was just shocking to hear it said, but I'll have to verify and look up that one. I'll look that one up. We'll cover that on Monday. So on Monday's show, we got nothing to talk about with earnings. We got nothing to talk about the economic calendar. So I will leave it up to you guys. If there's things that you would like me to discuss on the show, great. I have added everybody's names so far that has participated on our challenge for the Excel. And let me see here real quick. I'll bring it up so we can see. I'll scroll through here, and if you guys don't see your name on it, I'll do it. Okay, is it fake? Okay, it could very well be. When I read that, I was like, you got to be kidding me. No way would you say that. So I'll scroll through here just in case you guys see your name on the screen. This is the S&P. We got quite a few on here this year. I think we got a few on there. But there we go. Those who emailed me, those who put it on the YouTube channel, those who typed it into chat, I got your names on the list, so there you go. Our range goes from Ed in San Jose, thinks the S&P at the end of the year could be at 48.18. That's a decline of 13.67%. And on the top of this list, we've got Michael G. He thinks 7,700 on the S&P, a gain of 37.95%. And most of you are on the plus side here, and there's a handful of people that are on the downside for the year. We're definitely part of the minority there. Is the end of year prediction for the S&P? John G, it's for the S&P and for Bitcoin. And I don't see you on the list, so type it on in there. Type your name in there, and I'll add you to it. So that will do it for me. I hope you guys have a fantastic weekend. Do something fun. If you do something joyous, I guess. If you're in the Southern California area and you got some space, see if you can help out some of your family and friends who might need it. Send positive thoughts and prayers if you got them to the great powers that be to stop these winds. I mean, what we would love is just if we got a couple days of rain would be amazing, but it's been a long time since that. Liz, yes, we are doing the same thing we did last year, which is I'm giving out a prize for whoever gets closest on the S&P 500, and I'm also doing Bitcoin this year. So put in your Bitcoin forecast and S&P, or email it to me at tradermerlin@gmail.com, and I'll get you guys added to the list. Thank you so much. Have a fantastic weekend. Here we are, 55 minutes, no 1 hour show. I'll see you guys on Monday. Take care.